Where CRAs get your data. Business credit is credit obtained in a business's name. It's independent of the owner's credit history and scores. Business credit reporting agencies rely on objective data to calculate their scores. Objective and useful business credit data comes from a variety of sources. A business credit profile is independent of a consumer credit profile. It relies on somewhat different data, but it all points to risk. What is the risk of your company defaulting on its payments? All of the credit reporting agencies have the same mission. They measure whether your business can pay its bills on time. The differences are in the details. Some CRAs weigh public records more heavily, whereas others weigh payment history more heavily. Credit reporting agencies want to know your business's experience in the public sphere. This includes bankruptcies, liens, and judgments. This information generally comes from court documents. In the United States, PACER provides information on federal court cases. See www.pacer.gov. You can also find public record information at BRBPub. See www.brbpub.com. Credit reporting agencies are looking for filing dates, whether a bankruptcy or the like has been resolved, and closing dates. They also want to see the basics on court cases to determine if your company could be sued by another party at a later date. IRS information comes in several forms. In general, this is tax lien filings. They aren't connected to courts. Instead, they have a filing location like a county. The IRS also has information on whether your company is a sole proprietorship, partnership, corporation, etc. This gives information on the makeup of your company. Credit reporting agencies like Experian strongly suggest companies report to them. See www.experian.com/business-information/data-contribution.html. They suggest creditors report because, if borrowers know a company reports, those borrowers might pay faster to maintain better scores. It is a means of rewarding good credit to conscientious borrowers who pay back on time. And reporting alerts other creditors that a company has borrowed and thereby might be about to overextend itself, which means it might not be able to promptly pay its obligations. Every time you fill out a credit application for your business, you are providing data for credit reporting agencies. This includes industry classification, amount of time in business, and the number of employees. The first time you self-report is when you apply for a DUNS number. You provide information such as the company's physical location, whether a company has a DBA, which stands for Doing Business As, plus the site of your headquarters and any other company locations. D&B creates the D&B rating. The rating contains a financial strength indicator. It is calculated using either the net worth or issued capital of a company. If both figures are available, then net worth is always used. D&B will show if a business is new or if they never got this information. It also adds a condition code or risk indicator. This calculation measures the amount of risk the creditor can expect by taking into account key items in a D&B business information report, which are used to predict the likelihood of a business failure. A company gets the lowest rating, A5, if no information is provided. Credit reporting agencies receive payment data and other company details from lenders, suppliers, and creditors where your company has accounts. This is from vendors which report. However, even vendors which do not report can provide data. If you ask for a trade reference, a trade reference is subjective. The other information is all objective. To recap, credit reporting agencies work with objective information. It is readily traceable to government records or court records and other organizations. The only subjective information is trade references. Contact us today to learn more about where CRAs get your data.